The VIX failing to break above 13.5 for 2 months. That is the longest such streak since before the financial crisis. Welcome to Trading Nation. I'm Eric Chemi. Today we've got Wald from Oppenheimer and Max Wolff from 55 Capital. Max, let's start with you. When you see this relationship with the VIX, markets overall, and this long streak of just such low vol, what does that get you to think about?
Yeah, so certainly we wonder a little bit about market sentiment. It seems to be sort of all up all the time. On a more specific basis, when we look at the VIX, which we spend a lot of time thinking about risk, and the VIX gets implicated in those discussions often, at least in the public space, the VIX is very good at doing a very, very narrow thing over a very, very narrow time frame. So VIX really gives us 30 days worth of visibility on the SPY. That's kind of all it does that pretty well, but most people have portfolios that can run over lots of different assets and lots of different geographies and lots of different time frames. So one of the major cautions here, and this is a great reminder, is don't think of the VIX as doing a whole lot more than it does, or you're going to build an awful lot on a foundation that's kind of narrow.
Ari, let's bring it over to you. I know before the election, everyone talked about the risks, the uncertainties, and how we might get all this high vol. And in the end, we got the exact opposite, right? We got the lowest vol we have seen in a long time. So what do you make of that? What do you think the next move might be?
I make it is what we're seeing is a characteristic of a very healthy bull market. And what we found is, and really in general, the VIX is a very misunderstood indicator because it has an asymmetric payoff. You can buy spikes in the VIX. They tend to be opportunities to buy stocks, but you can't sell stocks when VIX is low because historically bull markets, you tend to see a low VIX throughout the advance. We ran the numbers behind it. Forward returns on the S&P 500 generally higher when VIX is below 15 than when it's above it. And you can see it in the overlay as well. Low VIX characterizing much of the 1990s as well as the mid-2000 bull markets. And if you look at those major tops in 2000 and 2007, the VIX was above 20 in both those instances. So there's a lot that we worry about. Low VIX isn't one of them.
It also seems to be another thing that maybe you guys are not worried about, and maybe it goes to the bull market, the low vol. If we go to the back of that Oppenheimer shot right now, I see basketball games on all those TVs behind you. So does that suggest that maybe right now traders are actually more focused on, hey, it's a bull market, vol's low, I'm focused on March Madness, and check in with me in a couple of weeks?
I suppose there could be something said about that. I mean, in general, the checks are healthy. I mean, what we're seeing between low VIX, rates moving higher again, participation broad, the right leadership, it's really your classic signals of a healthy bull. I guess the point being that we just don't see those signs of a major market top in place here. And because of that, we still recommend investing like it was a healthy bull market.
Well, there you have it. Ari is positive. He's bullish for the time being. Of course, thanks for coming here on Trading Nation. Max, thank you for being on Trading Nation. And to all our viewers, thanks for watching. I'm Eric Chemi. We'll catch you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.